Well, happy Monday, March 20th. Wanted to catch you up on the latest activities here in the Austin market. To kick things off, we're going to take it global and start talking about some of the global issues that are going to have an impact on the local market. First of all, if you were paying attention over the weekend, we've now had our third bank crisis in the last 2 weekends. So UBS, which is a major bank in Switzerland, was basically forced to go buy their rival bank, Credit Suisse. Now, Credit Suisse has had issues for over a decade, so it's not like the interest rates of late are the reason they collapsed. They already had major issues. But of course, the global banking situation with interest rates rising put even more pressure on this bank. Ultimately, Credit Suisse was heading towards collapse. So the global banking elite decided to force UBS to basically buy their rival Credit Suisse to calm the waters and take at least one more banking crisis off their hands. So what's happened over the last year, if you go back to March of last year when the Federal Reserve started raising rates, there's only been one story: inflation, inflation, inflation. And so the Federal Reserve has been raising the interest rates to try to slow down the economy, to try to slow down inflation. And up until about 8 or 9 days ago, that was it. That was the whole story. Now, in the last 8 to 10 days, we've had 3 banks collapse, 2 in the US and 1 in Switzerland. And what's happening now is the Federal Reserve now has a completely different issue they have to manage, which is pulling them in an opposite direction. With inflation, they're hoping to raise rates to slow down trade, to slow down hiring, to slow down people buying things so that inflation comes down. However, when banks collapse, because interest rates have put pressure on them and it's going up, what's happening is the Fed now may have to pivot and slow down raising rates so that they don't create a bigger banking crisis. And so the Federal Reserve is going to meet this week and decide what they're going to do. Are they going to not raise rates at all? Are they going to raise it maybe a quarter point, just a little bit of a rate? Or are they going to go heavy and go 50 basis points, which about 10 days ago, people thought they might do because inflation wasn't slowing down fast enough. Now they've had to pivot. Now they have 2 different things to focus on. So what's happened now to mortgage rates because of these banking situations? So if I come over here and look at the 30-year fixed rate mortgage, this is looking basically at about the last 10 months. It's been super volatile. So if you've been a buyer or you've been a seller in the market, you've felt this. So we started last summer. Actually, this is last probably March. We were down in the 4s. Then it rocketed it up the beginning of last summer to 6, then back down into the 5s, then way up into the 7s, and then back down almost to below 6 again in February of this year, then way up to 7. That was right before the banking collapse of Silicon Valley Bank back a week from Friday. Since then, what's happened is people have rushed into the bond market because they're scared. They're scared that maybe the banks aren't as safe as they thought, and so they're now rushing globally over into American bonds. That has driven the bond yields down, which in turn brings mortgage rates down. So we've dropped over 0.5% in a little less than a week. So right now we're back into the mid 6s. This would be for, let's say, a primary home buyer out there shopping. I've said from the beginning of the year, if rates can stay between 6 and 7, I think our year is okay. I think we're kind of going to go sideways. If they zoom up above 7, it's just going to continue to put heavier downward pressure on buyers. Fewer buyers can afford the properties, and it will put stronger down pull on price. If rates drop farther and maybe go down to 6 or even below 6, it could theoretically spur the market a little bit and maybe help some appreciation. However, if rates are dropping below 6 and they stay there sustainably, it's probably because we have a recession. And so I think mentally that could be another hurdle for buyers. So in reality, we're kind of watching the market every week. I feel like the interest rate's been 0.5 point different. And it's hard to get a gauge on the market, how that's going to trend with buyers. I can tell you right now, the market's okay. Open houses are getting traffic. We're seeing more activity. So let's go over and look at statistically what's happened between January and February. So January's over here on the left, February's over here on the right. So our median sales price at the end of January was around $450. Last May 2022, it was $550. So from May of last summer to January, it dropped $100,000. Okay. Since then, it's still trickling down, but it's going at a much slower pace. If I look over to February, the total market median sales price is 436. It's come down some. Days on market was 76 in January. It's still going up. We're still having slower sales cycle. Newer listings, however, in February were below February of last year. Why? There aren't as many sellers selling their homes. And so we haven't seen the buildup that we had from March to about October last year, when it was just this huge wave of buildup of inventory. Now I think sellers are being a little more cautious and many sellers have to go buy again, and they just don't want to be a buyer, and so therefore they don't sell. Compared to last year, obviously active listings are way up, but there aren't as many sellers coming out to list. Pending sales are down, but not as bad as they were in January. And so it's tightening a little bit. That gap is tightening a little bit. Months of inventory is about the same, 2.6 months. I'm going to scroll down here. This is City of Austin. Let me get to City of Austin on this chart. So now we're looking at January and February. In Austin, the median sales price was $525 in January, and now it's $530. Kind of flat still, honestly. Days on market still going up a little bit in Austin. Again, new listings down a little bit, or flat compared to last year. And months of inventory is about the same. So Austin's kind of flat right now. And I think if interest rates can stay right here, I predict that's the way it's going to stay. I think we're going to be kind of flat. I think we're getting more sellers coming out into the market now that it's spring. We're going to get more buyers coming out, and they just wash each other out. I'm not seeing one overtake the other like we did last year, where we went from huge buyer demand and no listings to no buyer demand and huge amount of listings. It was this huge swing last year. Right now, they're just kind of trending with each other. I think it's because interest rates they're not really that predictable, but they're staying in a range, 6 to 7. And if they can stay in that range, that provides some predictability to the market. So, right now, I think that's how things are trending. I don't expect we're going to see this big boom in appreciation. I don't see prices spiking back up. I also am not feeling prices crash, because interest rates aren't going high enough to quell or slow down the buyer interest in the market. We're really back to kind of a 2017, 2018 pace of sales. It's okay. Price is kind of meandering sideways. And I think that's how it's going to continue to trend, even with all these crazy stories going on. If the Federal Reserve ends up not over impacting the mortgage market, which is a huge question, but if they stay in this 6-7 range, I think the market will continue to stay flat. So they're going to make a decision on Wednesday what they're going to do with their Fed rate. That impacts what investors do in the bond market, which impacts mortgage rates. So if you're planning to sell or buy right now, just pay attention to all this. My job is to keep you informed every week, so you just have a flavor of what's impacting the markets locally. If you're a seller right now, again, watch active comps. Look at your competition. Don't worry about what somebody sold for a month or two ago, because interest rates might have been at a different point. Buyer mentality might have been at a different point at that point when they were writing those offers. Focus on active listings. Your job is to beat active listings on the market. If you're a buyer right now, again, have great conversations with your lenders. You got a nice little boost over the last week by not having rates stay at 7. They've come back down to 6.5. And so if you're actively shopping right now, this might be a nice window to be able to lock in maybe a mid-6 rate. Or again, let's see what happens this week. I think interest rates are going to go up or down in some fashion by the end of this week, depending on what happens with the Federal Reserve and those announcements. So just pay really close attention to that. But again, if you're a buyer, even though rates are volatile, the good news is you have a lot more homes to look at than you did this time this year. In fact, you have 384% more homes in the city of Austin, or 387%, if you're looking from January. A lot of inventory, 4 times as many homes. And so there's a lot to look at and gives you an opportunity to think about it, look at homes maybe a second time. Hopefully you won't have somebody that you're bidding against, and you have an opportunity to get a great home at a good price, lock it in, and then if rates come down in the next few years, you can even refinance to make the debt situation even better. Anyways, I hope this is helpful. Wanted to share this data. I plan to share it with you every single Monday. And I will also be uploading those to my YouTube channel. So check that out, Ryan Kelly Group. at YouTube. You can see all of my weekly reports and my monthly reports. We're going to start warehousing them there. And feel free to share that with anybody you know if they want to keep in touch with the Austin market as well. Hope this was helpful. You guys enjoy your week and talk to you soon.